Let's have a look at debtors control. Let's assume I have an entity. So here is my entity, and we're gonna assume that this entity is selling goods. So here is our goods, and it is selling these goods on credit. So they sell goods on credit to our other party, which we're going to call Mr. X. So here is Mr. X. Selling goods on credit to Mr. X. The value of these goods, let's assume it is 3,000 Rand. Now, because the question says that we sold goods on credit, what that means is Mr. X didn't have enough money with him. So he said, alright, I will buy these goods at 3,000 Rand and I will promise that I will pay you this money back later. So Mr. X then owes the entity 3,000 Rand. We can say that the entity actually owns 3,000 Rand, even though the entity doesn't have this 3,000 Rand in its possession, because Mr. X still has the 3,000 Rand. The entity owns the right, and at any time they can go to Mr. X and say, hey, Mr. X, please give us this 3,000 Rand, because we've already given you the goods for this 3,000 Rand. So technically, 3,000 Rand that you have belongs to us. So we can say that the entity owns this 3,000 Rand. So whenever the entity owns something, we know that the entity has got an asset. So because of these goods that were sold on credit, the entity is going to have an asset. So let's look at it from the entity's perspective. Here's the entity. And we can say that Mr. X, the 3,000 Rand that he owes us, is going to be an asset in the entity's books. And that asset we're going to call a debtor. In accounting, the correct term is debtors control. Because the entity owns the right to go to Mr. X at any point and demand this 3,000 Rand. If we look at it from Mr. X's perspective, so here we go, Mr. X. In Mr. X's accounting records, he will have a supplier called, which will be the entity's name, which for our example, we'll just call it entity. And he will actually owe 3,000 Rand to this entity. Because he owes this money to the entity, in his records he will have a liability. And that liability is going to be called a creditor. And the accounting term is creditors control. So just to recap again quickly, the entity who sold the goods on credit, they will have a debtor, which is Mr. X. So the entity is going to have Mr. X as a debtor. Mr. X, in his accounting records, he owes money, so he's going to have a liability, which is called a creditor. Just to clarify then, even though it says here that we sold goods on credit to Mr. X, the entity has got a debtor in its books. Right, so even though they sold goods on credit, that doesn't mean they've got a creditor. That means that Mr. X owes them money, so they actually have somebody that owes them money, and that is going to be an asset because they actually own 3,000 Rand. Even though the 3,000 Rand is not in the entity's possession, it's in Mr. X's possession, but Mr. X is merely keeping this 3,000 Rand on behalf of the entity. Good. Now our entity may have many such debtors as Mr. X. So let's draw the scenario here. Got our entity and they own many such debtors. So let's just put all our debtors here in one big group. So inside here is Mr. Y, Mr. Z, and we've got another business in here, number 1. We've got another business in here, number 2. And in here as well, we've got Mr. X. Good. So you can see the entity may own various such debtors. And these are going to be assets for the entity, and it's known as debtors control. So a question may typically stipulate that the debtors control balance for the entity is 26,000 Rand. And what that means is the entity owns 26,000 Rand from various people to whom they sold goods on credit. And these people actually owe the entity money. So the entity owns this 26,000 Rand, even though it's not in their possession. They do own that, and it thus is an asset, because at any time they can go to these debtors and they can go and collect that money. But now we may have a problem. Let's say we go to Mr. X. So now when we go to Mr. X and we look at what we actually own and what he owes us, we may find that Mr. X, here we go, here's Mr. X, he actually owes us 3,000 Rand. Now, so this block represents the 3,000 Rand that Mr. X owes us. And when we ask him, Mr. X, can you please pay? We find that Mr. X cannot pay because Mr. X's assets are smaller than his liabilities. And in fact, just the month before, the executor of his estate issued a notice to us saying that he is actually been declared insolvent and he will not be able to pay us all the 3,000 Rand that he owes us. So Mr. X is insolvent. His assets are smaller than his liabilities. And we receive a notice that we will receive only 400 Rand. 400 Rand only will be received by the entity. The rest of the debt, so if you say this will then be the rest, this remaining portion is what we are going to have to write off. So of this original 3,000 that we owned, this portion here we are going to have to write off. And that portion is 2,600 Rand. So what we're going to do with this portion? This is, first let's go to the original 3,000. The original 3,000 was an asset for the entity because the entity owned that. But now the entity no longer owns the full 3,000. In fact, it only owns this portion here, the 400, and the remaining 2,600 is kind of lost. It's gone. So this 2,600 here, this is lost. You say this is lost. We're never going to get that money. We're never going to see it. This debtor has been declared insolvent. So this money that was lost is going to be an expense in the entity's records because it has been, there is no economic benefit that we can get from this 2,600 Rand. So there we go. The 2,600 Rand is going to be an expense, and that expense we are going to call bad debts, because it was debts that was owed to the entity originally, but now since the debtor was declared insolvent, we can say that a part of his total debt has now been lost, and therefore we're going to call it bad debt. Right, so my asset, what's happening to my asset? My asset is decreasing by the 2,600. Here we go. And my expense is increasing by the 2,600 Rand. So you can guess what's my debit and credit going to be. This asset account, we call that debtors control. So the asset decreased, so that's the opposite of debt click. So that's going to be a credit. And my bad debt is an expense that increased, and debt click, if we apply that, debit expenses if they increased, so that's going to be a debit. So there's your journal entry. We're going to debit bad debts and we're going to credit debtors control.